All right, so we've looked at financing leases from the leasee and the leaseor and sales type leases from the leaseor standpoint. Let's switch gears just a little bit and look at how does an operating lease impact our financial position and how do we account for an operating lease. For the leasee, it's not a whole lot different than the finance lease, and they did that because they wanted to ensure people didn't automatically just change their leasing into one-year leases and then sort of do a contract off to the side that guarantees they'll renew a one-year lease for 20 years. So they were trying to avoid that situation. So you end up recording very similar to, you have to put the debt there on your books from the leasee standpoint. Now the leaseor is a completely different ballpark. So let's look at this example and sort of see what's going on. On January 1st, Nathan Langstrom Services Incorporated, a computer software training firm, leased several computers under a 2-year operating lease agreement with Computer World Leasing, which routinely finances equipment for other firms at an annual interest rate of 4%. The contract calls for 4 rent payments of $13,500 each, payable semi-annually on June 30th and December 31st. The computers were acquired by Computer World at a cost of $97,000 and were expected to have useful lives of 5 years with no residual value. Both firms record amortization and depreciation annually. All right, so step one, we need to look at this and say, is this a financing lease from the leasee standpoint? So to do that, what do? Well, we need to find ask our 5 questions. Does ownership transfer? The answer is no. There was absolutely no purchase option in here, so we don't even have to worry about that. The lease term versus the economic life. This is a 2-year lease, has a 5-year life, so therefore we are not using a substantial portion of the life. Now we need to find the present value of the minimum lease payments. We'll check that. And then the last thing would be if it's specialized, and computers are not specialized. So really, the only criteria here that could turn it into, say, a finance lease instead of an operating would be the present value of the minimum lease payment. So I'm going to go right here, and I'm going to find what my present value of my minimum lease payments happens to be. So again, I'm going to do my negative PV. Our rate here we know is 4%. This is an annual rate. It's annual payments, I believe, wasn't it? Yes. Okay. And the semi-annual, so it wouldn't be 4%. My apologies, I read that wrong. It would be 2%. So our periods here, it is a 2-year at twice a year, so it's 4 periods, which they tell us right there, 4 rent payments. They're payable semi-annually. So since that's an annual rate of 4, we have to bring that down. And then we're going to do our payment amount, which is $13,500. We would not have a future period, but when's the lease payments due? Well, this is January 1st. And then we read, it says that it calls for 4 rent payables payable semi-annually on June 30th and December 31st. So therefore, this would be a default ordinary. Okay, that's a little bit different. So we're going to have the asset for 6 months before we make that first payment. When we check our PV, we get 51,400. Is that a substantial portion of the 97? Again, a ballpark figure would be about 90%. And in this case, that is nowhere near 90%. So this lease does not match or meet any of the criteria for a financing lease. So as such, we have to treat this as an operating lease. So what does that mean for us? Well, from the leasee standpoint, really not a whole lot of difference. Just a little bit of a tweak, and I'll show you what that tweak is. So the cool thing is from the leasee, we don't have to think too much about it. We still record, just like we would before, the right of use asset on our books. And we do that at the present value, I forgot the word asset on there, at the present value of the minimum lease payment. So it's still going to be that present value. Notice it doesn't equal fair value. Occasionally we put the right of asset on our books and it doesn't match fair value. This is one example. Another example, again, is when there's residual value that is different. So sometimes we would not have that either. So keep that in mind. Sometimes the right of use asset does not equal the fair value. It really depends on the situation. And then we're going to still record a lease payable. And again, this was just to make sure we didn't have that issue where, hey, now that a 12-month lease a lot of times could create a way around making it a financing lease. And if it wasn't, then every time you made a rent payment, you would just pay rent expense, and that would be it. So what FASB tried to do is make sure that we didn't go and sort of say, hey, let's do 10 years worth of 6 months leases, and every 6 months you promise me you'll re-sign, and we'll just let you sign every 6 months. That way you can discharge rent expense. You would have an operating lease. We wouldn't have to worry about this. So to avoid that situation, FASB sort of built in a change to operating leases. So now we still have to record a right of use asset, or at least that's my take on it, and then the lease payable at 51,404. Again, like before, we have an asset, so our assets are going up and our liabilities are going up. At this point, no income or cash flow issues. Now, moving on June 30th, we would make our first payment. Just like before, we would do our interest expense. Now, notice we didn't do a payment at the beginning of the period, so we don't have to worry so much about that. We just need to go in and do a normal end of period payment. So we're going to go in, we're going to hit our interest expense, our lease payable just like before, and then our cash. Okay? And in that, our interest expense would be our carry value, the 51,404, times our rate. Notice it was 4% per year, so it would be 2%, or 1,028. Our cash payment we know to be 13,500. So without doing an amortization chart, we can quickly just back into the amount of the lease payable. Now, also, since we have an asset, we have to amortize the actual asset itself. So we are going to go in and hit amortization expense, and we're going to hit accumulated depreciation, or excuse me, not accumulated depreciation, I'm off, the right of use asset. So used to saying accumulated depreciation in other classes. So we're amortizing, so we're going to hit it straight to the asset itself. Now here's where the difference comes. What we're going to do is we're simply going to make the amortization, instead of doing straight line in an operating lease, you make it equal to the lease payable. Why, you say? Well, we didn't want to create a situation where we were charging different expenses like we would for a financing lease. So if you add these two together, the total expense that you would show on your income statement for that period would equal the historic rent expense. You're like, well, what's the difference between just charging rent expense? Now on your books for an operating lease, you have the lease payable. Okay, so that shows that required payment for that period of time, versus in the old operating, we would simply record rent expense for 13,500 and cash for 13,500 every 6 months, and we would be done. Or if we paid at the beginning of a period, we'd hit prepaid rent. So this puts on that debt, that piece of payable in the liabilities that show, hey, you are under contract, you have to pay these lease payments, so therefore you have a debt on your books. So what's the overall impact? Well, our cash is going down by 13,500. Our liabilities are going down by 12,400, and our equity goes down by 1028. In addition, our equity is going to go down also by the actual amount, so that the net of those two, notice in a financing they do not match, but here it equals what would have been in the old system rent expense. So we're not changing the necessary makeup from the income standpoint, but we did want to ensure that that payable went on the books. Also, our assets are going down. From a revenue standpoint or an income statement standpoint, our expenses go up. When expenses go up, our income comes down. So that's the same way here. That's supposed to be negative. There we go. And negative. But we also have cash event. These are outflows. Now, here's the difference also. All of the payment would be operating. We do not charge this as financing. I know normally in a financing lease, when you're the leasee, this is a financing activity. That is not the case for an operating. When you have those payments on an operating for the lease payable, it actually goes to operating expense because it's an operating lease. All right. Now, same thing here on December 31st. We're going to have some very similar action. We're going to go in. We would make the interest expense and the amortization. The interest expense would be calculated. Remember, we had our lease payable minus the payment we just made on it, multiplied by the 2%, so 779. Oops, why did I hit that? Sorry. And then 13,500 for our cash payment, and then our lease payable would be the difference between the two. The financial statement impact would have been exactly the same, except the numbers changed slightly. And then we would go in for our amortization. Our amortization would equal, again, the lease payable. So notice, over the life, we will fully amortize the $15,404, just like the lease payable. But we do not do straight line. We do it exactly the same as we do the lease payable. So we don't want to do straight line amortization. Okay? All right. That is the leasee side. Next, we'll switch in and look at the leaseor side. So let's look at the leaseor side in an operating lease. What would they do to actually record this lease? Well, basically, they just treat it as rent revenue or lease revenue. They would not have a receivable. They do not remove the equipment from their books. They would still depreciate the asset as if they owned it. So from the leaseor side is where you're going to see a drastic shift in how we actually account for it. So notice, when we're looking at this, the first lease payment's not due until the end of the period. So it's going to be a little different. So on January 1st, when we sign this contract, we're not going to receive anything. The leaseor just has a contract and that's it. So they do not need to record a lease receivable at all. So really it's just no entry on January 1st. Now, I will say, if we receive that first payment like we would if a beginning of the period, so let's say we signed the lease and then we went in and did that first payment, what you would record here would be the cash for the $13,500, okay? And then you would have a deferred revenue. And I can't remember if it was lease revenue or what, but cancel. Let's see what it would be here. We would have a deferred lease revenue. Did I even put it in here? Probably not. I did not put it under liability. So it won't let me type. So let me add that to our chart of accounts here, just for the fun of it, so you can see. It is not needed for this entry. So this is not the answer to the entry. But had that payment been due on the very first, we would do deferred lease revenue of some sort. Okay? And it helps if you spell deferred right. There's one F and two R's. There we go. So it would be a deferred lease revenue that we would hit. So from the leaseor standpoint, if we did receive that payment up front, we would hit deferred lease revenue. Then at the end of the period, we'd adjust it and turn it into revenue. So keep that in mind. If we did have an upfront payment, it would simply be deferred revenue. Now in this case, the first payment's not due until June 30th. So what we would do here is we just do no entry because one, we signed a contract, but from the leaseor standpoint, nothing has changed financially. We still own the equipment or the asset that we're leasing, whatever it is we're leasing. We have full rights to that asset. We're just allowing this person to use it. So think of maybe you renting an apartment. They still have access. They still own it. You don't own it. The ownership doesn't sort of tend to go your way in any shape or form. They retain it. So they'll depreciate it as if they have that asset themselves. Okay? So June 30th, when this happens, what happens? Well, we receive that first payment. So one, we're going to get the cash of $13,500. Now here, all we would do is call it lease revenue. Just like you would rent revenue, or anything of that standpoint. It's just rent revenue to us. And that's all it is. We record it as such and we go on. Okay? Now, the other thing we have to remember though is we do have to depreciate the asset. So we will hit depreciation expense from the lessor standpoint or leaseor standpoint simply because they still retain complete ownership and use of this asset. Okay? You're just sort of borrowing it from their standpoint for that time period, like a leased apartment. You can use it, but you can't make any drastic changes to it, anything. It's not, you don't act like the owner outside of you stay there. You can put your stuff in, but then you have to take it all back out when you leave. Sort of things like that. So we will depreciate the asset as normal. So let's go up and see. The asset would have had a cost of $97,000 and a 5-year life. So what we would do is we go in and we do, all right, the asset cost us $97,000. We would divide that by 5. Now keep in mind that $19,400 would be an annual depreciation. We're only doing half a year here, so then we would divide that in half. So we do $9,700 in depreciation at this point in time. Okay? Notice that's a major difference between a financing or sales type lease from the leaseor and an operating lease. Then on December 31st, what would we do? Well, we'd actually record the exact same entry. every single time. We would go in and record the $13,000 payment. Notice there's no interest, there's no lease receivable. It is straight rent revenue, so to speak, but we call it lease revenue because it is a signed lease in that. You could also call it rent revenue. So a big difference, really big difference between the two. Now, if we had recorded this so say our first payment was due on day one, we would have done cash deferred. Here we would do deferred revenue, lease revenue, and then cash deferred again because we'd receive another payment. So you'd actually add a little bit of a step there. So if we did receive payment on day one, so let me just scroll over here. If we had received payment on day one, what would we do? Well, like I said a moment ago, you'd do cash and deferred. Then on June 30th, you've earned that and you're receiving the next payment. So you'd actually do the deferred and then the lease revenue. Then you would also receive the next payment. So you do cash and deferred again. And then you would do the depreciation and the accumulated depreciation. So same concept. The only difference would be is the timing. Had we received that first payment, you would have to record that as deferred until you earned it at the end of that semi-annual period. On June 30th, you would earn it. Then you'd receive the next payment, and then you would depreciate. And then in December, you would do those same 3 entries all over again every single time that you've recognized the revenue and record the deferred for the next period. Okay, so timing of the payments would make this a little different. Keep that in mind. But I wanted to make you aware that that first entry, if we receive payment, would be deferred revenue, and then we'd still recognize the lease revenue on June 30th. It just changes how we record it slightly. All right, so what's our balance sheet impact here? Well, every single time we're going to receive a payment, we get the cash. The full amount of that is revenue. All of it is lease revenue, not interest revenue. You would not have any interest. Now, here it is a operating activity just like before. It's an operating lease. So this cash flow of $13,500 would be from operating activities. So this would be a plus OA. Now, anytime you record depreciation, you're going to reduce your asset because your asset values are going down as far as the book values go. Then we would record depreciation expense. That means our expenses go up. When our expenses go up, our income is going down. And there is no cash flow with that. Okay, so when we record the next two, it would be the exact same impact every single time through the entire life of this lease. So notice, operating leases from the leaseor standpoint is a lot different. Okay, so I'm going to save this as progress so I can post this when we're done. All right, so any questions there, let me know, but that is the calculations. You still, as the lessee, record a right-of-use asset. The big difference between the lessee in a finance versus an operating is the fact your amortization matches your lease payable. So that way, the lease expense that we record as the lessee would match the lease revenue that they record on their side. So notice it would all be lease expense or rent expense in theory, but the way we have to get to that point is sort of questionable. Or not questionable, but different. Let me say it that way. It's not questionable, that's GAAP, but it is a little different. So we want to go in and record that. Normally speaking, when we report this, we would report them net. We'd show them together as one expense for the lease. So they would be reported as one on our income statement as some type of lease expense in that respect, as to avoid confusion with our counterparts. So any questions on that, let me know. I will go ahead and work on getting the other videos done for you. Have a great day.